options. In contract, we can do that, right?
Okay.
But you cannot control the market. You can control your own agreement, but you cannot control the market. You cannot say the market is going to be fixed against dollar. You cannot do that.
Okay.
Otherwise, the whole financial system is going to be disturbed, and it's going to be starting a chain reaction that is out of your control. Look at the financial crisis. It started from US and now it is shifting to the China after 10 years. Now the latest news is that the biggest property giant in China, Evergrande, is bankrupt. More than 400 billion US dollar loan is need to pay back. And look at
is due to what? To the COVID? Because of the COVID?
Not because of the COVID, because there are a lot of stuff going on. So the crisis is now first started to Europe and then now turning to the China.
Okay.
So this is a very complex subject. We'll talk about in some other time, because it has other things to do with this stuff. Because every country is now connected. Chinese are also taking loans from other countries. US also taking loans from other countries, because the deficit is it is a kind of a loan. Your exports are higher, your imports are lower, your imports are higher. So who is going to fill that gap? The World Bank give you the money and charge you some interest. This is like that.
Mm-hmm.
Okay. So let's take a break and then we start again. Okay. Okay, welcome back after a short break. So we finished our discussion regarding the government's attempt to influence exchange rate can lead to international disputes, and we talked about the controversies or the disputes of all time, the China and US dispute, and we talked about the US perspective argument and Chinese perspective argument as well. And now the factors that can affect the foreign direct foreign investment or foreign direct investment. Some call it FDIs and other books call this DFIs. So it's one and the same thing. Okay. So why we are studying this? Because these factors can also increase the flow of capital, right? We talked about in our that lecture, which increases the flow of capital. One was the outsourcing, and the second one is foreign direct investment or direct foreign investment. Number one, changes in restrictions. The factors that affect the direct foreign investment, that why or what factors that causes other countries to invest in our country. Number one, change in restrictions. So when new opportunities have arisen from a removal of a government barrier, right? What if there is, a change in tariff, or there is some, tax haven is announced. Tax haven means when the government say that, okay, the foreign companies, if they are coming to our country, we are not going to tax them for 5 years. So we call this tax haven countries. Or there's a one, space or one land over there on which all the companies, foreign companies, if they register the companies over there, we are not going to tax them for 10 years or maybe 5 years or 8 years. So we call this tax haven states or tax haven countries. So if the government announces, a reduction in trade barrier, so government, the countries receive some kind of investment, and we call this direct foreign investment. So direct foreign investment can be, in terms of investment in your stock market, purchasing of your existing companies, or making or developing a new, company, or establishing a new factory of that company to your country, right? So second to is privatization. Privatization means you are selling your government-owned entities to outside world. So privatization, so direct foreign investment is stimulated by new business opportunities associated with privatization. First, you were basically, okay, the water supply company that is government owned, and now the government is selling that entity to some private investors. right? And what happened? The other countries, they showed the interest that, okay, we want to buy this facility. So the money is coming to your country. Capital is flowing to your country, right? So international flow of capital. Let's continue this. Number four, one is factors affecting the direct foreign investment. Number fourth, potential economic growth. If your future is very good, that okay, your stock market is going to increase, then what happened? Other countries start investing in your country. So we read that argument that even if US is having sorry, too much, uh, current account deficit, then why its value is not going down, or why we don't see any kind of like, weakening economy over there, because of financial industry over there is very strong. On the other hand, their imports are very high, but we see another phenomena that other governments are also depositing, or the residents of other people, other governments, other countries, they are saving their money with Wall Street or with the banks as well. So they are importing more. On the other hand, the value of dollar increases. Why? Because on the back hand, people want to invest over there and receive higher interest over there, because the financial industry is very, very strong, right? So if there is a potential for growth, what happened? The people, they start investing in your country, or maybe just opening a saving account with the banks. That's it. So that when currency increases and they receive interest, when they convert that interest and principal amount in their home currency, the exchange rate increases, so they will receive more money, right? Tax rates. If income tax rates or corporate tax rates are lower, then that country attracts more foreign investments. So capital will flow from that country who tax the company at higher rate to that country who tax the company at lower rate, right? The corporate taxes, where the corporate taxes are lower, that country will receive more foreign investments. Exchange rates. Firms typically prefer to pursue DFIs in a country where local currency is expected to strengthen against their own. So right now, their currency is low, but you understand that, okay, the currency is going to increase against your currency. For example, if you are in Vietnam and you analyze, you have this international finance knowledge, and you realize that, okay, the country is doing very well, the Chinese are doing very well, I think in 1 year, the yuan going to increase. So what you are going to do, you save your money with Chinese banks and you wait. You are receiving interest, right? After 1 year, what happened? Chinese yuan valued upward. When Chinese yuan upward, it means the Vietnamese currency goes down. So when they convert their interest plus principal and convert from yuan to Vietnamese currencies, they will receive also currency appreciation gain as well, right? So this is how you can benefit from currency exchange. But it can also affect the foreign direct investment. Why? Because simply the international community realize that, okay, your currency is going to appreciate, so we are giving you the money. And you receive that, okay, oh my God, we are having so much investments in our country. But if they realize that your currency is going down after 1 year, they are starting pulling out their money back. And then you receive, okay, and then you receive a Great Depression. Because all the, the blood of a country, which is the currency and the economic factor, they sucked up all the stuff, and then you are just like the country is in paralysis. So that's why the government introduced the capital flow restriction. You cannot, like China, if you are a foreigner, you cannot withdraw more than $500 in 1 week.
Yeah.
Right, guys? So why these kind of activities are here? Because they want to stop the flight of capital. So be used to, make yourself comfortable with different terminologies. The purpose is the same. Money is going out from the country. We call this capital flight, right?
Can I have a question? I ask you a question.
Sure.
As, regarding the transfer of the okay, so the limitation is 10,000, I think, per year, right, for China company. But if it's like a foreign direct investment, so it means I mean, you know, when you move, you do a bank transfer. Some are for invoice, and some are just like net income will go back to the company, to the how we say, to the headquarter. So if it's a branch in China, the net income must go back to the main houses, like the
Head office.
head office, right? And so regarding those money transfer transaction, does it matter what is the source of the transaction, is if it's like an invoice, or it's just like the net income will go back to the head office?
No, because they have registered as a company, and company operation is to sell goods, to incur the cost, and difference is your profit. They revert to the head office. So the government rule is that if you pay the taxes and all the things you do, the legal stuff, you pay taxes, nothing, fishy about your company, that you can withdraw your money. All the, like Apple Corporation send all its profit back to United States. So they don't
Yes,
have
sir.
this $10,000 restriction. Why? Because they pay taxes on that one. So that the government wants. Okay, if you want to come exploit my, business opportunities, and you move all the stuff without giving back anything else to the Chinese government, then it's illegal. Then we cannot do that. If you are a registered company, okay, you can invest here through legal means. So we know that where the money is going, whether you pay taxes or not, you maintain the employees' rights, society rights, and all the stuff. Then you can take back your money, right? But for individual purposes, we are not, as an individual, I'm not coming back through official channels. I'm taking money with my pockets, like $10,000. I'm just coming back in my pocket and just invest in China, and then going back after receiving $15,000. So that's really a fishy area. Then they will realize that, okay, why you are coming with the $10,000 and you're going back with $15,000. Where is the source? How did you earn this extra 5,000? Did you pay the taxes? And you need to prove that one. If you prove, you can go back. Otherwise, you cannot go back to your, take back to your capital, to your home country without a specified limit. Otherwise, there's going to be a chaos in the country. Why? Because everybody start doing this stuff. Why? If the Chinese currency is going down, right now it's going down, so they are not receiving much return, so they want to invest in that country where they want to receive higher interest. If everybody start doing this kind of stuff, then country is going to into economic paralysis, ultimately going to Great Depression, right? Then the state or the central bank comes and they make these kind of policies, right? So the point here is,
And my last question,
yes,
all,
sure.
all of this information, you can go to one, I would say one institution, and they will give you all of the detail, or you have to do it by
No.
yourself, go to each
They will
area.
make this process a little bit boring, a little bit hectic. Why? Because so that people are discouraged to take their capital back to their country. If they make it very easy, then they will feel, or everybody start doing, sucking their money up, and then what happens?